Good afternoon and welcome to today's webinar, The Valuation Game, How Investors Price Startups. For many founders, valuation can feel like one of the most challenging aspects of raising investment. Understanding how investors assess risk, growth potential, market opportunity, and key business metrics is essential when seeking funding and negotiating with confidence. In today's session, we'll explore how investors think, the metrics that matter most, and the modern valuation strategies shaping investment decisions in today's startup landscape. I'm pleased to introduce our speaker, Daniel, founder and consultant who specialises in helping businesses raise funding and secure investment across multiple industries. With extensive experience supporting organisations, from startups to established businesses, Daniel has guided countless companies through the funding process and helped them unlock opportunities for growth. We're delighted to have him with us today to share his knowledge, insights, and practical advice. Daniel, thank you for joining us, and over to you.
Thank you, Annabelle. Good to be here again with another really important topic and one that can be very confusing sometimes to first-time founders who haven't been through this journey. Why does valuation matter? Well, valuation isn't just a vanity metric. It's not a number that you see on LinkedIn and TechCrunch or in your marketing. As many top VCs like to look at valuation, it emphasizes usually the mechanism upon which your company's trajectory is dictated. So it's almost like the valuation. Sorry?
Sorry, there seemed to be a connection problem for a moment. I don't know if it was at your end, my end, but it all seems fine now.
Okay. So yeah, valuation is often dictating your company's trajectory from the get-go. So it's setting a price for your equity from day one. And often there aren't the normal metrics on which business valuation is calculated. You know, these startups are often young companies without huge historic trading. They might not even have much or any revenue. So valuation is super important, and how you come about your valuation in the fundraising process is super important. And one of the important things here as well is not to think that bigger is always better. And in fact, there's been many instances of companies raising money very aggressively early on, and everything seems very successful. However, when they come to later stage valuations and fundraising, maybe even IPO, and then investors are able to look under the hood into those businesses, maybe the unit economics and the metrics are not all that they thought they would be. And actually what ends up happening is that the share price plummets. And that's kind of a worst case scenario which you want to avoid.
So I think we're going to move on now to looking a little bit more at the investors valuation playbook and what makes investors say yes. So if you could talk us through this, I think this is one of the things that everybody wants to know, how to get an investor to say yes to your opportunity.
Yeah, so we touched on some of this last week, and these are really the first things that investors almost expect to see, and things that they take for granted sometimes. You know, if you're going to approach a venture capital firm for investment, they expect you to have a very, very large total addressable market, or TAM, as it's noted here. They expect you to show them that you're going into a huge market, and that if you command a decent percentage of that market, you're going to be able to turn into a multi-billion pound company. So these things matter, and matter a lot. But once you get into some of these other factors, actually, they're all about building confidence to the investor and de-risking. We mentioned this, I think, in the first webinar, that investing from a VC perspective is a little bit like placing lots of bets. But they have lots of startups asking them for funds. So they're usually de-risking startups to help them decide where to spend their money. And Seed Camp, one of Europe's best known early stage investors often says that it's not really a precise accounting science when it comes to early stage. It's more an exercise around risk profile and pattern matching. In other words, what else is happening in similar spaces, similar industries, similar technologies, as to how they actually get to a valuation. But all of these are things that they'll expect the founders to think about and show and prove diligently how they're going to tackle the not necessarily the fundraising process, but building that business.
I mean, it's interesting here, that statistic about 42% of startup failures are due to the fact there's no market need for the product. How would you best evaluate the market need?
I think this is where it can be done in many ways, but this is a really really stark actually statistic. People often think it's lots of other reasons why they fail, but actually there are many times people are building businesses that customers don't either have a need for or don't see an immediate need for, or maybe there's a need but they're not going to exchange money for that need, so the need isn't big enough. And this is why you want to prove this as quickly as possible, and this is part of the earning the trust and validating the business to your investors. So even when you're with an idea, there are lots of ways of proving or starting to prove that there is a need, whether it's questionnaires, whether it's research online, whether it's generating waiting lists. All of these things are ways in which early stage businesses can actually show there is a need. Of course, what's always better is actually having paying customers, having a product having a product that people have started paying for, and therefore you're validating your business idea in the best possible way.
And I think, sorry, Daniel.
No, it's okay. Often I was going to refer to the previous slide. Usually in early stage businesses, it's the team that they are evaluating above all else, because they know that there are lots of big markets and they might see early stages of growth and traction, which is great. But the founding team is really what sells them the idea and sells themselves at the beginning, because they all know that you're going to be on a 10-year journey and there are going to be lots of ups and downs, and the business will look very, very differently to what you're pitching today. They expect it to look differently in 1 or 2 or 5 years' time. So what they're really assessing is that founding team and their ability to handle the journey, adapt, their ability to be self-aware of what they can and cannot do. So I would say there's one thing here that is a constant, no matter how big the opportunity, and maybe even your early signals of traction. If the founding team can't get the confidence and can't win over the investor, they will not invest in early stage businesses if they don't have confidence in the team.
Now that makes a lot of sense. And it's like you touched on in the last webinar, it's very much about, building those relationships as well, and that they want to be able to know they can work with you long term, and that you're going to be able to collaborate with their own teams as well.
Absolutely. And then I think when it comes to how they value businesses, again, this isn't a science necessarily. So they look at different ways. I think some of these are more for later stage businesses. And again, if we focus on early stage, which is where hopefully our audience is, and maybe they're building or starting to build.
Definitely where I am.
They are often looking at other methods. So comparable startup analysis, they'll often see what else is happening in the market in terms of early stage businesses. Obviously, they'll look at research and they'll expect you to sometimes come with, why are you valuing your business at 5 million? And maybe some of your validation as a founder will come from comparables in the market. Another way that they'll often look at it is in a almost like taking the end result and working its way back, the venture capital method, which is you're entering a market which is worth 100 billion in total. You're saying you can command 20% of that market, which is a 20 billion revenue business. And what will be the valuation of that business if you generate 20 billion, and then work its way back to what they think they should invest now, which is 10 years in advance of what their what they're planning for, what you're planning for. So they'll use all these methodologies to help them come up with a number. And I think usually one of the things I see happening in fundraising rounds is it's not very often that you come with a valuation and that valuation sticks. It's often a negotiation, a discussion. The market will usually tell you what you're worth in terms of what the investor feedback is to you. And of course, there's always the get your first investor committed, and they can usually create FOMO and help you drive your fundraising process. But even then, you may end up in a negotiation on what that valuation could look like.
That's
By the way, an interesting example, Uber. I always like to use this example. When Uber first went to get their first check, they didn't really have any fundamentals, but the VC essentially looked at the size of the taxi market in somewhere like San Francisco, and they looked at if there was an opportunity, if they believed that Uber could get a proportionate size of that market. And then, of course, they factored in all the risk that they're taking, and they came to a valuation. I think it was around 5 million for that first check. So they kind of look at it in lots of different ways. And a lot of it is building that trust. It's not about numbers only, because the numbers it's so early. Those numbers aren't there yet. The metrics aren't there yet.
Is it always a 10-year kind of period, or can it sometimes be a shorter period of time that they're looking at?
I think generally, and it varies a lot. The 7 to 10 years is maybe a rough average of from your first investment to maybe an exit. And this is again where VCs often realize their actual money is when there is an exit. So either you're acquired privately or there's an IPO and the shares go public. And then that's where the VC can cash out and earn hopefully their big rewards for backing you and investing in you from those early days. But they know it's a long journey to build multi-billion-pound companies. And let's remember, these investors are not necessarily interested in 50 million exits. They are betting on big exits. And that's why they know these things take time. Albeit with AI, as we spoke last time, we are seeing companies get to very large valuations very quickly. Fundamentally, they still need to exit. They still need to sell in order for the VCs to realize their gains. So yes, it is typically a multi-year process.
And I know you've already touched on this a little bit, but can you talk us through a little bit more about what drives higher startup valuations?
Yeah, and I think this is where de-risking and giving confidence. And how do you do that above storytelling and selling yourself? It's about data points that VCs look for. And actually, these are what gives them a sense of some predictability and some defensibility. So for example, recurring revenue. Even if your revenue is relatively low at the beginning, just showing that you've got customers signing up to subscriptions or memberships or recurring monthly revenue gives the investor confidence, not just because you're getting regular income rather than one-off invoices, but also because the customer must have confidence in your tool, technology, software, product in order to say, yes, I'm going to commit to paying for the next year or 2 or 3 years. So that's a very strong signal if you're starting to get recurring revenue. User acquisition and growth is also very important. Showing that you can get an engine of more customers joining you, hopefully quite rapidly, is important. And again, what I would emphasize here, even though in the early days the numbers are relatively small, maybe it's not millions of people, actually the growth trajectory is what's important. If you're able to show double-digit percentage growth week on week or month on month, that is super interesting to the VC because it gives them the impression that once you have more funds, maybe that can happen in much bigger numbers. And of course, anything proprietary around technology is super important to show them that you're building something that hopefully is defensible. because whether you have competition now or later, they'll want to see that what you're building is not something someone can come and build over a weekend or over a 6-month period to potentially take your market away. So these are things that if you come armed with early indicators and data will help you. I'll give you a really good example here, which hopefully most of us will know, which is Stripe.
Mm-hmm.
Stripe, the communication tool. And I remember when I was with a startup that we started using it in the early days. What Stripe proved really, really early on was when they went into a company, and some of them weren't big customers, they started with a small department of maybe 10, 15 people. But very quickly, because of how effective and how much the user was loving the experience, other departments within the business would come on, which showed not just user acquisition, but growth within an existing account. And that gave them the ability to really command a high valuation because the investors trusted that if this is happening with medium-sized companies, just imagine what this would do if they managed to get themselves into very, very large multinational companies. That user growth engine becomes exponentially more important and more strategic in how you actually scale to a multi-billion-dollar company.
That makes a lot of sense. And I can see also there's a mention of patents here. Is that something you would say that you need to get done prior to going and trying to raise the funding?
I think it really depends on the type of technology you're building. Patents are obviously very popular if you have something around algorithms, if you're doing medical healthcare, health tech, those kind of things, absolutely patents. You could look at patents for lots of different types of technologies. Sometimes, and again, it depends on how patentable that is. Investors will put a lot of weight behind it. And it also shows them that actually what you're building is potentially protectable. So these are good, again, good signals and good things to look at if you think it's something that's patentable. So yes, absolutely, companies use it where it's relevant.
Thanks, Daniel. I did wonder about that one. So that's interesting
Annabelle,
to know.
just another point. Strong founding team on that page. Again, what we are seeing more and more is, if you go back one slide, if you don't mind, what we are seeing more and more is that people going to raise money in the early stage, there are more people coming with MBAs, doctorates, coming from established university helps. If you're part of a incubator or an accelerator that's renowned, like Y Combinator, for example, or Techstars and these kind of places, it's almost like you're part of a cohort that has an added element of credibility. Even to get accepted into some of these universities, incubators, accelerators is a huge challenge, and the numbers are stacked against you. So that's where strong founding teams, even if they're young, might not have huge maybe careers to show. Actually showing that you've been accepted into these places can be very effective. But I would always say, similar to myself, who has never gone to what I would call a very high-end established university, and I haven't taken my startups through incubators or accelerators, you could conversely say, actually, I can show other things as to why maybe I'm a strong founder to back, which might be my experience in launching startups, how fast I might operate, et cetera, et cetera, et cetera.
No, that makes a lot of sense. This one quite statistic heavy. I'll hand it over to you to explain a bit more, Daniel.
Yeah, I guess it's a following nicely from the last slide. What valuation do investors never ignore, or sorry, valuation multipliers, and it comes back to the data. If you can show data around what you're building, how fast you're building, but essentially users, who is using it, how many are using it, how often they're using it, are they paying and staying with you, which is net retention revenue, NRR, which we see here. Those are numbers that VCs don't ignore. And that's where they actually can start, and you should start as a founder to say, actually, if I can prove already with X number of users that my acquisition number is X, my retention number is Y, and they're paying me Z, how will that look if I manage to get 1 million customers? And then you're showing a growth trajectory, a scalability to your investor or potential investor backed by real numbers. And that's why even early numbers can be strong indicators. But this is where those type of trigger points, data points are super important, because those are things that investors can't argue with. They can't argue if you're generating £500,000 of revenue without any marketing. It's there, it's in black and white, and it's data that gives them confidence. And that's why I always say to early stage companies, you've got to think from day one, how will I acquire my customers? How will I go and get my customers? And start early. Go and get them from day one. That's why MVPs or version 1.0 of a product are there, to get your early customers to come with you on that journey, and to start showing you're able to go and get customers. Showing a beautiful product without thinking about how you're going to get people to use that beautiful product is not good enough for the investors.
So to a degree, would you say that understanding how that product can be marketed is also very important when you're looking at funding?
Massively important. It's no longer good enough to say I'm building a product and I don't have an idea of how to do those other things, marketing, sales, customer acquisition, because there are so many people building. And actually the ones that sometimes, I always say that it's not the best product that always wins. It's the one with the best distribution or the best marketing. And that's why there's lots of examples of products that are technically superior to competitors, but maybe their revenues are nowhere near what those competitors are. So you've got to think from day one, how do I go and get those customers? And even if you're doing it at the beginning with relatively small numbers, it's validating your business idea. And it's also showing you maybe how easy or how hard it is to get customers to come and join you. But that's why the data points are so important, even if the numbers are relatively low at the beginning, which they'll expect. Investors will expect in seed and pre-seed that you're not a multi-million-pound machine that's already got lots of metrics.
No, that makes sense. And I think we're going to have a little look closer at kind of the mistakes that you need to avoid, which again, I'm sure the audience are very keen to know more about this one, Daniel.
Yeah, and one of them here is what we just spoke about: weak go-to-market strategy. Maybe the investor doesn't think that you've thought through how you're going to acquire those customers. And that can lead, and if you're not coming from that market, if you're building in a new market or a new industry, that's especially something that concerns them. If you're saying I'm going to create a multi-billion-pound company in the world of HR, but you've never worked in HR, that will be flags to them to say, actually, you don't know how the ecosystem works. You don't know how people procure or buy HR systems. So that's one obvious one. But I think for me, the biggest one here is limited market validation. At the beginning, you will have limited market validation. You've got to think of how you can hack that. How can I really get data points to actually prove that the market does want my product? Because VCs don't want to back a product where they're not convinced on whether people want it. So as much as you can give lots of macroeconomic reasons and lots of things around what's happening in trends and things that actually my customers will or customers will want to buy it, they don't want to take that bet. So they're asking you to prove to them that you validated the market. Other things, I think, unrealistic financial projections. Yes, there are companies who become multi-million-pound companies within a number of months. But if you're going to say that, you really have to back it up. And you really have to show them why you've thought that through and how that can happen. And I think sometimes people in the world of technology, especially if it's enterprise level, so you're selling to big companies, underestimate how long it takes to get customers, keep customers, prove to customers that what you're doing is correct, because organizations are still very much procuring with people. So there are usually, if you're selling to B2B SaaS, if you're selling to tier 1, tier 2 customers, the large customers, you're having to go through layers of people approval, budget approval, decision-making approval. So they want to know that you're not giving them something that they just look at and say, this is not realistic. Automatically, they'll then question everything else you're doing. And it is all a process. I always say sometimes a process of say as little as you can without putting them off. Because sometimes the more you say, you can give them a signal that actually might give them less confidence in what you're actually doing.
That's interesting. I would have always thought the more information you can provide, the better. But it's interesting with you saying kind of keep it to the minimum. Do you mean then let them ask the questions so they can ask for the information they want?
Yeah, I think it's not keep information away from them, but I think it's anything you're going to talk about and the things that you research that the investors are going to want to know about, really know your stuff. And I actually, when I work with founders and I come and help them with fundraising, I'm almost the devil's advocate. I'm challenging them in why they're telling me things that if I don't believe in it, or sometimes I do believe in it, but I need to hear how they're actually communicating that across to the investor. And a lot of it is in that communication process because you're building trust, you're building confidence.
Making me think of Pete out of Dragon's Den.
Well, we said, in these programs, as soon as you don't know an answer on something financial, straight away you're on the back foot.
Yeah, absolutely. And so now I think we're going to look into a little bit more about why startups fail. I'll let you talk us through this. There's some figures here that really do surprise me, but I'll let you talk us through it and then I'll ask you a bit more.
Yeah, so I think these are all quite interesting statistics. A lot of people are usually surprised by a few of them or where they are in this ranking. The reason why investment is so important is because often early stage businesses building groundbreaking technology or groundbreaking business models do require a lot of cash. And so fundraising has become I don't want to say the most important part, but one of the most important parts of running a business, because you may constantly need to get more cash before you're fully sustainable and generating enough revenues to back your growth yourself. And yes, running out of cash is a big problem. I like to focus on the second and third because, again, I always like to think these are sometimes things that you can prove quicker and earlier without going to the market for fundraising. In startup world, people know about the lean startup and they know about a terminology that says move fast, fail fast. The reason why fail fast and lean startup work is because before you have product market fit, maybe you shouldn't go out and get money if you can help it. Because product market fit is your validation as a founder that what I'm building, people want. I'm not just going off my own hypotheses, my own ego, my own I know it all. I want to see that early traction. And as we spoke, it could be about interviews, questionnaires, research, people joining waiting lists, people trying a product, even though it's not perfect. So people need to show this very, very early doors to themselves, I almost feel, as a business, because you don't want to find out something critically important that is a reason people aren't buying your business 1 year down the line, if you can find out earlier. So my perspective is always, how can we get to this validation as quickly as possible? And it might be qualitative data, but at some point, can we move it into quantitative, which is how many people are actually putting their name down on a waiting list, or ideally, how many people are paying for a product or service? And poor market timing, economic conditions can also often be there. It's important you understand the macroeconomics of the market and sector you're going into. If you're going into a market that people aren't investing in, for example, and especially with VCs, whilst a lot of them focus on certain sectors, it is cyclical on where money is spent. So sometimes sectors are not in demand, and you might need to be aware of that. And then you ask the question, why aren't they in demand? Is there an underlying reason why people aren't investing in HR technology, for example? And you want to understand those if you are going to go into the market to raise money, but also if you're going to go into a market that you might think is huge and growing, but actually the research might say it's reducing for some reason, it's changing.
So
which one strikes you as an interesting one?
I think, to be honest, I'm surprised by the very low percentage of why startups fail due to the competition and market pressure. I would have thought competition and market pressure would be up there with the higher percentage of why startups fail to raise funding and kind of get off the ground.
Yeah, it's always a bit of a surprising one. And again, while startups need to understand the market they're going into and their competitors, and the competitors are not always direct competitors, i.e., doing very similar things to you. You might be fighting for budget that covers lots of different, let's say, use cases or problems that you're not thinking of. So you have to really understand the market, understand the problem you're solving, and think about competitors in a quite wide sense. But at the same time, if you're getting that early validation from customers on what you're building, or they're telling you actually that's not solving a problem, you need to pivot, often the competition isn't killing you. It's other things. Maybe you haven't moved quickly enough to pivot your product. Maybe you haven't changed your pricing strategy, which is ineffective in the market you're trying to go into. There's often lots of reasons which are not around competition, because one thing that we have seen in technology countless times is good technologies are able to disrupt markets all the time. That's the truth.
Yep. One thing you just mentioned there, and that was quite interesting to me, was the fact that even though there can be kind of market pressure and the competition there, if you've got something really worthwhile and you can back it up with the data, you can go in, you can disrupt industries. Are there any examples you can think of to share with us?
Oh, good question. I mean, again, Uber's a great one.
Yeah.
Going into markets that actually nobody would have thought are that sexy necessarily.
Yes.
And they just had a different vision of how that market was going to operate. But actually, fundamentally, they just changed in how they brought technology in terms of how the consumer engages and books that service. The service is pretty much the same. The car comes, picks you up, and takes you somewhere else. Obviously, we are seeing autonomous vehicles, which is probably the next real game changer in that market. But they came in with a solution that now looks obvious. And sometimes simplicity of changing a market behavior is something that works very well. But even then, they had lots of competition in various cities around the world. There were established legacy companies who were working there. There were competitors who came after them who commanded certain market shares. So it hasn't all been plain sailing. But obviously, they've pivoted their business in many, many directions, many ways, ordering food, etc. But I think there's lots of examples in every market nowadays of how people are disrupting. Look at social media. Everyone thought Facebook had this huge monopoly.
Yes.
But actually, TikTok comes along and says, we're going to cater for a very different use case. And you think, well, all you're doing is short form videos, which YouTube and Facebook pretty much turned out pretty quickly, that kind of offering. But again, TikTok was able to almost create a niche for itself with the type of customer demographic they were going after and the type of marketing. So they built their own segment, if you like, or they were able to get customers to acquire to come on board. But you could argue they weren't doing something that crazy. They just showed shorter videos than what YouTube showed and what Facebook showed. Obviously, there's a lot more behind it, but I think there's lots of examples of this happening all the time.
I mean, TikTok's an interesting one that you mentioned. What they did do different that I know about is TikTok Shop. So you don't have to leave the platform to buy a product. So you can just click, buy, but you still remain in the platform, which encourages people to buy the products because it's kind of, you do it without thinking about it.
Yeah,
so
absolutely.
Buying, but very much encouraging compulsion buying, and obviously encouraging the reviews of products by the users on the platform, and then offering, a commission scheme if you want to become a TikTok seller. So they don't even have to market the products because they're getting the consumer of the platform to do it for them. So
and often what's really interesting is often a lot of these, let's say, features and things that we see now maybe weren't even part of their roadmap when they first went to raise money. We all know the story of Netflix, that actually their first idea was that you just order online and they send you a disc in the post. So they took a
I'm old
journey.
enough to remember doing that, you know.
Yeah, and so they again they didn't actually start off by saying we're going to go to blockbusters, but now you go straight to streaming. There was a certain evolution in the journey, which again, this is why investors are taking a long-term bet on individuals, because they know that journey is not going to be, I'm investing in you today on this idea, and the idea is going to pan out exactly how you said it will. In 10 years' time, we're all going to have a multi-billion pound company and we'll exit and it'll all be fine. They know there are constant ups and downs and huge product pivots and changes. They want to back you. And part of the fundraising process is giving them confidence across all these different factors that actually you are one of the founding teams that we want to back. Because we believe you're going to be in it for the 10 years and be able to adapt and deal with these constant changes that are happening. And now they're happening even quicker because of AI, the changes are.
Of course. And then I think this moves us on quite nicely to the AI valuation framework. Quite a few terms here that I'm not very knowledgeable about. So if you could talk us through those a little bit more and maybe share your knowledge with our audience.
Yeah, so as we see AI helping everything scale, and technology companies are moving quicker, launching quicker, proving things quicker, adding huge efficiencies, and also growing into substantial companies pretty much within some months or a few years, that helps elevate the valuations. But again, the market has evolved since AI has come into the mainframe of venture capital. Investors don't want to hand out money or premium valuations to, we called them last time, the wrappers, those products where you're building on top of an existing API or LLM, large language model, and you're just adding your own UI and UX. If it's relatively simple and quick to do, they might not see the defensibility. So they don't want to necessarily back those companies, whereas a few years ago, they probably would have. They want to see some of these pillars that are going to give them confidence that says, actually, this is something that will stand the test of time and will give a higher valuation to a company. Proprietary AI, we spoke about it last time, whether you've got unique data sets, whether you're building infrastructure slightly differently, something that gives you a competitive advantage that isn't easy to copy. Owning quality data. This is something that the LLMs, the big companies, are all fighting around. Rather than just using generic data on the internet to blurt out answers, how can we own very, very strong quality data to help our models perform better? Infrastructure scalability, all these kind of things are things that are important. And then we also mentioned vertical AI. So actually, companies building in a very specific industry, and this could be any industry, legal tech, health tech, etc., where you're saying, actually, I'm not maybe building the foundation model of the AI, but I'm using it to focus on a very specific, narrow problem in a very large market. And you might say in legal terms, don't ever use a lawyer again. I can build an AI agent that's going to be your lawyer. And I'm going to show how I'm going to build that in a much more efficient, scalable way that actually hundreds of millions of people can use and give me a competitive advantage over traditionally people going to a lawyer to do anything, whether it's a business transaction or whether it's creating a will or doing other legal things.
Quite a few of those now where you can just create your own legal documents without having a lawyer involved, using just these platforms.
They are, and if you line them all up, the VC or the investor would want to see which one is maybe building something that's defensible, rather than maybe which is the one that's growing the quickest, although that's interesting for them. Which is the one that's building something defensible that in 3, 4, 5 years' time the others won't have, and they might fall by the wayside because there's always going to be someone who might build something slightly quicker, slightly cheaper. But maybe I believe this one's building something defensible that's going to have something unique about it and give it that extra value, and also that ability to last the race, that ability to last the 10-year period whilst others may fall away.
Yes. So in some ways, I must admit that's something that I haven't always thought of as such a prime important factor is that market defensibility. You know, as an early kind of startup founder, I focus more on things like showing that it can be profitable and sustainable growth. How do you demonstrate that market defensibility? What's the best way to go about doing that?
A lot of it will come, especially in AI, it comes down to technology. And that's where you often see successful businesses early on have strong foundational team, and usually one person will be very technical. Investors often like founding teams because they like several core strengths. Maybe one of the founders is technical, maybe another founder is commercial. That's usually a good mix for them. But they often, it will come down to, especially with AI, something technological. So that's where you need to prove maybe your vision of how technology is going to move, what you're going to build. Maybe you have a roadmap that gives them certain confidence on what you're doing. And it is very difficult, by the way, to show this on day one or even after 1 year. So again, you're partly storytelling, hopefully using some data and driving that confidence, because the investor will also know that nobody's going to tell them on day one or even day 100, I have something here that no one else can build and it's going to change the world. So they are always taking a hedge, a bet as to how much they believe you, how much they trust you, and how much they then believe, okay, you can build that, but actually you can also deliver other things that the business will need alongside that proprietary technology, for example.
Are there any of these stages that you think are kind of more applicable for early startups when they're raising funding?
Which stages are you referring to? Are you referring to what's on the page now?
Yes, sorry. Yes,
Yeah.
so like sustainable growth, AI powered efficiency, so on and so forth. Is there any of these stages? I know we touched on market defensibility and the importance of that. Is there like anything else that you feel is more important to
I think this is where investors look at a very all-rounded approach. And that's why you almost have to tick all of the boxes for them to a degree. And build confidence in all of them. They'll still be able to identify maybe you have weaknesses in some places. They might say, actually, you're financially maybe weak in terms of proving to us how the unit economics work, but maybe we know something you don't from other portfolio companies. We can help you along.
Mm-hmm.
And often I would say the investors, the good investors, are there to help you along.
Yeah.
So they might be able to help you figure out, how do I have a clear path to profitability? How can they, I might have my own opinion, but they might be able to give me a more experienced vision. So I think I wouldn't say there's any time one that's more important than the other. Although I would say founding team in the early stages, when you've got very little metrics, is often the way to show who you are and what you've done already and why you're the right person to do that, to build this business is probably a little bit higher than the others. But this is where the game has slightly changed. That, for example, sustainable growth wasn't being talked about a few years ago. I've been in companies where, in the board meetings, the VCs sometimes didn't ask us about profits. They just wanted to focus on growth. Now it's sustainable growth. So show me how you're going to get to a point where for every £2 you spend to market and acquire a customer, you're getting way more than £2 back, hopefully. And even if you're not, show me how you're going to get there.
Mm-hmm.
So show me how things might improve so that I can see that there's a point at which you do become sustainable. Maybe that's breaking even. Maybe that's showing certain profit. Show me how, AI efficiency, you've got to say how you're using AI within your business, even if it's not a proprietary technology of yours. How are you using it to run your operations better? How are you using it to scale your marketing better? How you can do it, how you're using it to go to become a 50-person team in 3 years, not a 150-person team.
Yeah. And I mean, sorry.
Yeah, no, I think all of these are important in their own way. And you just got to cover all these bases, and That's why the journey of fundraising is super interesting, because you'll be challenged with all of these things, and you'll learn as you go along what investors want to focus on, what do I need to improve my pitch on, where am I slightly weaker, and that will, that's part of the journey of fundraising, really.
Do you have any advice for our audience if they feel that their company is being undervalued?
I think don't become too attached, certainly not emotionally, to the number, to the valuation you might think you're worth, because the market, I think, always tells you what you're worth. And very few startups go to market and then have the choice of their investors, that they can play off each other to get a higher valuation. It's often that you might have a handful that are interested, hopefully. They might tell you that they value you slightly less than what you believe. And this is where it's a negotiation, it's a discussion, and you have to think of what's important to you at that stage, knowing that very few people actually raise money. So if you are offered money, investment, you're already ahead. And this is where you probably have to be a bit pragmatic. And I think it always comes down to a couple of things. Number one, how much equity do you want to give away from day one? And you have to realize that because this is a long game, you're going to end up giving a lot of equity along the way, probably, in order to build a £1 billion company. And the other thing is not giving them the idea that you can achieve unrealistic goals. Because if you over pitch it, oversell it to try and get a higher valuation, and then you don't deliver on those goals, then you get into real difficult times where your next round might value you at less. So it's called a down round.
Right.
This is really the most, I would say, it's an awkward, very difficult position to be in, because now the people that you sold this huge vision on of constantly getting the valuation up and up and up and up, you're now in a situation where actually you can't raise at the valuation you wanted, because the new set of investors, which might be your existing investors, say, actually, we will give you more money, but we don't value you at 5 anymore. We value you at less.
So would you say it's better to raise more or less at the early stages?
This is a really interesting dilemma. And the answer is neither when they're extreme is optimal. I always like to think that when you come to the market, you should think of it from bottom up. I'm currently a business in this space, and I want to be here in a certain different space in 18 months. And you should always think 18 to 24 months away. Where do I want to be in 18, 24 months in terms of revenue, product, team, etc.? And what do I need to get to that milestone? That should be the starting point of how much you want to raise. The valuation almost comes after. And that's where sometimes I wouldn't go into a fundraising with a definitive valuation. Often, I've seen founders best do it by saying, we think we're going to be valued between A and B. We're happy to listen to what the market tells us. Of course, this changes once you have commitments from certain investors. If an investor says, I'm ready to go, I'm giving you X, if you're happy with that valuation, you can actually use that to go to all the other investors you're talking to and say, hey guys, we've got an investor. They're willing to value us at this amount. Will you follow along with them? That gives you much more credibility once you've got something to hang on to. But until you have that first offer, be ready to be challenged on valuation. It's not because they think what you're doing is not as good as what you think you're doing, or your progress hasn't been great. It may be just because higher valuations do create challenges later on if you don't achieve your goals. And also remember, the investor you're talking to has to go and sell this opportunity to his colleagues and get them to agree. So they have to go through other due diligence and other decision-making processes. Be aware of that. Be empathetic to that. And that's why I would be kind of just not too emotionally attached to a valuation. And of course, where this is different is when you have numbers. So once you get to latter stages of fundraising, round A, round B, and beyond, you're actually judged a lot more on your numbers. What is your revenue? What is your head count? How much are you spending on an acquisition? What's your margin? All these things are much more used to determine your valuation later on, where both you and the investor can actually say, here are the numbers in black and white.
Yeah.
We value you at A, B, or C. And of course, again, it becomes a discussion and negotiation at times.
So obviously fundraising happens multiple times during the business life cycle. Just to finish off this webinar, would you be able to just briefly talk us through kind of how that works?
Yeah. So if you're going into that multi-billion journey, you're going to raise money several times. This is where those stages that we kind of become familiar with, pre-seed, seed, round A, round B, etc., come from. And they're really just one follows the other as the business becomes more mature. And this is something else to remember, that the investors you're with from day one will possibly be with you throughout the journey. And they'll need to also agree with you on what you're raising, at what valuation, who else can come into your cap table, who else can join the valuation. So you're stuck with those early stage investors for good or bad. And it's super important to, from the get-go, earn trust, build confidence through transparency, because they're going to be with you that whole journey. But as I said, what changes is that every single stage, you become less risky. At seed stage, you're the riskiest. So sometimes that's where people will back you, but they want a bigger chunk of your company. Because I'm taking such a risk, all you have is an idea and an MVP. Therefore, I'm taking a bigger risk investing in you. I want more % of your business. But later on, you've suddenly got all these other metrics to show them how the business has grown and developed and where it is today, that you're more in control to say, actually, I want to raise on my terms because I've proven certain things, and now you're viewed as less risky.
Mm-hmm.
So that's where the dynamic changes every time you raise. If you are continuously growing your valuation, generally that means the market is trusting you more and therefore assigning a lower risk profile to you. And that means that you're in a different conversation to what it is in the early stages.
Well, thank you so much.
That's the dynamic. Yeah, it's a very interesting dynamic, how that kind of evolves over months and years. And it's a really interesting journey to go on. Hopefully, when you're doing it in the right way and the business is performing, because if it's not, you end up having very difficult conversations if you are having to reduce or lower the valuation of the business. But hopefully our audience will have a positive journey and go in there with their eyes wide open and positive.
I've certainly gained a lot of clarity today. I've really, really enjoyed the webinar. So thank you so much for joining us, Daniel. And certainly looking forward to learning more during the next webinar that we will be holding next week. So I'll let you go. I hope you enjoy the rest of your day. And thanks again. It's been really enjoyable. Thank you. So make sure that you follow us. You can go to the London School of Emerging Technology website and find out when our next webinar will be held. There will be another webinar next week following on these topics that we have been going through for the last few weeks. There are also lots of events going on, so please check out the events that we have on. There may be some events that you would be interested in joining as well. And as always, we hope that you found this an enjoyable webinar. If you do have any further questions, do feel free to pop them into the chat, and we will do our best to pick up on those for you next week. So I hope everybody enjoys the rest of the day, and all the best with whatever you're